It sounds like there's a whole bunch of different methodologies that you deploy to do the valuation. I mean, I know you talked about the triangle, right? What's the market say about the idea, right? So if you're building carriages for horses and it's now the year 2000 and not the year 1900, there's a different emphasis. So there's a different push. And now you just mentioned some other aspects. What things do you bring? What do you look at? Obviously, where's the bank at? Who's the team? I get that part. What other elements do you take into consideration when you're providing a valuation?
So we put the business in its economic and industry context, right? That's sort of the first thing we do. We look at the company's cost structure and its margins. And so we use what I call a common size income statement. So all the categories are a ratio of or a percentage of total revenue. And what that does is it identifies where the costs are incurred in that business. We look at the profitability of that business. We look at the return on equity, the return on capital. We look at how it's structured. How is the business financed? We look at its asset base relative to its operations. We take a brief look at the capability of its assets to deliver the product or services that it's looking for, that it's looking to provide. So, it's comprehensive. It's not just a single thing. And then, we apply, right, when then we're back to that triangle, right? If we analyze all of those risks, that helps us understand where it is, right? If it's a good company or if it's not a good company, right? And if it's not as profitable as its competitors, then it probably gets a lower valuation. If it's top of the market, then you got to give it the higher valuation. But so this is going to lead into your next question, but that's where the risk assessment comes from, and that's where the expert can provide insight into the value.